With the U.S. markets now closed for the weekend, Plug Power, ticker PLU, ended a monumental week of trading. Friday's session on October 3, 2025, saw the stock close at $3.80, a staggering surge of 34.28% in a single day. The trading volume was simply immense, approaching 500 million shares, indicating a frenzy of activity from every corner of the market, from retail traders on the Robinhood app to institutional desks executing massive orders on platforms like Interactive Brokers. This explosive move was triggered by what appears to be fantastic news, a significant operational update on a major European project. But this is where the simple story ends. The expectation, fueled by this single-day rally, is that Plug Power has finally turned a corner, that its long-promised green hydrogen future is arriving, and that this is the beginning of a sustained ascent. The reality is that this rally, while impressive, is built on a foundation that remains fraught with immense financial and operational risks, and this recent news does little to solve the company's core, long-standing problems of cash burn and profitability. The market is cheering a single battle, but the war for Plug Power's survival and long-term viability is far from over. The catalyst for Friday's unbelievable rally was an announcement that the company delivered its first 10-megawatt electrolyzer array for a massive 100-megawatt green hydrogen project at Galp's Sines refinery in Portugal. This is a tangible milestone, a piece of hardware delivered for a cornerstone European project. In a market starved for good news from Plug, this was treated as a major victory. The stock, which had been languishing for months, ignited, hitting a new 52-week high and bringing incredible one-month returns to those who had dared to hold it in their Fidelity Investments accounts. The buying pressure was so intense it looked like a classic short squeeze, where investors who had bet against the stock were forced to buy back shares at higher and higher prices to cover their positions, adding fuel to the fire. An analyst at H.C. Wainwright also dramatically increased their price target from $3 to $7, citing the positive update and other macro factors. For the casual observer engaged in online investing, the story seems simple. Good news equals a higher stock price. But for a company like Plug Power, one piece of good news must be weighed against a mountain of historical challenges. This single event creates a powerful expectation of a turnaround, but it doesn't erase the underlying financial reality that has plagued the company for years. This brings us to the common ground, the powerful narrative that has kept investors interested in Plug Power despite its turbulent history. For many investors focused on U.S. stocks, the expectation has always been that Plug is at the forefront of the hydrogen economy. Proponents see a future where hydrogen powers everything from warehouse forklifts to long-haul trucks and industrial processes, and they see Plug Power as a key enabler of this transition. The company's ambitious strategy to vertically integrate, not just making fuel cells but also producing and distributing the green hydrogen itself, is seen as a brilliant move to capture the entire value chain. Investors using tools like Schwab Intelligent Portfolios or conducting their own research for self-investing are drawn to this massive total addressable market. The promise of a Department of Energy loan guarantee, which was officially closed in January 2025 for up to $1.66 billion, added significant credibility to this vision, suggesting strong government backing for the company's expansion plans to build a network of hydrogen plants across the United States. This is the grand vision that has attracted a loyal following and made Plug one of the most talked about stocks in the clean energy sector. However, the contrarian take, the harsh reality of the situation, paints a much more precarious picture. For decades, Plug Power has been a story of promise but not profits. The company has a long and well-documented history of burning through cash at an alarming rate. For years, it has operated with negative gross margins, meaning it was costing the company more to produce and deliver its products than it was earning from selling them. To fund these losses and its ambitious expansion, Plug has repeatedly turned to the capital markets, issuing new shares that dilute the ownership stake of existing shareholders. While the recent news from Portugal is a positive operational step, it doesn't change the fundamental financial equation overnight. The company still faces enormous capital expenditures to build out its hydrogen production network. Many professional investors who manage funds through Fidelity brokerage services remain skeptical, pointing to the fact that even with government support, the path to profitability is long and uncertain. The business is incredibly capital-intensive and highly dependent on government policies and subsidies, like the 45V tax credit, which can be subject to political changes. The reality is that Plug's survival has depended on its ability to raise capital, not on its ability to generate profits from its core operations. How many more shares do you think Plug Power will need to issue before it becomes consistently profitable? Comment below with your thoughts. To fully grasp the risks and opportunities, it is essential to understand Plug Power's business model. At its core, the company started by developing hydrogen fuel systems primarily for the material handling market. Its fuel cells power forklifts in the warehouses of major companies like Amazon and Walmart. This has been its bread and butter business, providing a solid foothold. But the grander vision, developed over the last several years, is to become a one-stop shop for green hydrogen. This involves three key areas. First, manufacturing electrolyzers, the machines that use electricity to split water into hydrogen and oxygen. Second, building and operating plants to produce green hydrogen at scale using renewable energy to power the electrolyzers. Its plants in Georgia and Tennessee are key examples. Third, developing the infrastructure for storing and distributing liquid hydrogen. This vertical integration strategy is what separates Plug from many of its competitors, but it is also what makes it so capital-intensive and operationally complex. For an investor using a platform like SoFi Invest, the company represents a high-risk, high-reward bet on the emergence of a completely new energy infrastructure. Looking to the future, the outlook for Plug Power presents two drastically different scenarios. The bullish case, which Friday's price action fully embraced, is that the company is finally at an inflection point. In this scenario, its new hydrogen plants ramp up successfully, achieving record production levels and driving down the cost of green hydrogen. The DOE loan provides the necessary capital to complete the build-out without excessive further dilution. High energy prices and a supportive policy environment accelerate the adoption of hydrogen across the transportation and industrial sectors. The company successfully executes on its large-scale electrolyzer projects like the one in Portugal, proving its technology and manufacturing capabilities. In this future, Plug Power leverages its first-mover advantage and integrated model to become a dominant force, finally achieving positive gross margins and eventually sustained profitability. Conversely, the bearish scenario is one where the operational and financial hurdles prove too high. The reality could be that the costs of producing green hydrogen remain stubbornly high, making it uncompetitive without heavy long-term subsidies. The company could continue to face delays and technical challenges in scaling its production facilities. The competition from other clean energy technologies, as well as from other hydrogen players, could erode its market share and pricing power. Most critically, if the company continues to burn cash at its historical rate, it may be forced to raise capital under less favorable conditions, further diluting shareholder value or taking on burdensome debt. An investor with an individual brokerage account must recognize that the stock's valuation is not based on current earnings, because there are none, but on a distant promise. If confidence in that promise falters, either due to missed operational targets or a shift in the political or economic climate, the stock could experience a rapid and severe decline, just as it has many times in the past. In conclusion, the explosive 34% surge in Plug Power stock is a perfect encapsulation of the extreme sentiment that drives this company. The market has seized upon a single positive data point, a successful delivery, in Europe, as a reason to believe the grand expectation of a clean hydrogen future is finally at hand. This event has renewed hope and created a powerful sense of momentum. However, the underlying reality for Plug Power has not fundamentally changed. It remains a company with profound financial challenges, a high cash burn rate, and a business model whose success is contingent on flawless execution of an incredibly ambitious and expensive industrial build-out. The tension between the incredible potential of the hydrogen economy and the brutal economics of Plug's current operations is the central conflict. Friday's rally was a victory for the bulls, but the long-term questions around profitability and sustainable growth remain unanswered, making this one of the most speculative and polarizing investments in the entire market. And don't forget, this is US Stocks Update. For